Silver supply does not fail loudly. It tightens quietly, constrained by geology, timelines, and decisions made years earlier. By the time markets notice, the limits are already in place. This is why silver's supply problem is so often misunderstood. It is not a future risk. It is a present condition that simply hasn't been fully acknowledged. For most commodities, higher prices trigger a familiar response. Production increases, marginal supply comes online. Incentives realign. Silver does not follow this script. Its supply is slow, rigid, and largely indifferent to short-term price signals. That rigidity is not accidental. It is structural. The majority of silver mined each year does not come from primary silver mines. It is produced as a byproduct of copper, lead, and zinc operations. This means silver output is tied to the economics of entirely different markets. Even a sustained rise in silver prices does not automatically result in higher silver production if base metal demand is weak or stable. The supply level most investors assume exists is, in practice, disconnected. At the same time, new silver projects face long development cycles. Discovery rates have declined. Permitting timelines have extended. Capital discipline has tightened after years of underperformance in the mining sector. These constraints are not speculative. They are already embedded in production forecasts. The pipeline cannot respond quickly, even under favorable conditions. This creates a ceiling that is difficult to see if you focus only on price. Markets are accustomed to elasticity. They expect supply to respond eventually. In silver's case, eventually operates on a timeline that does not align with market cycles. The supply ceiling is not a point in the future waiting to be tested. It is a boundary that has already been reached and normalized. What makes this particularly important is that silver demand has changed while supply has not. Industrial consumption is no longer marginal. It is embedded into systems that modern economies are actively expanding. Electrification, grid reinforcement, advanced electronics, and defense applications all require silver regardless of price. These demands are planned years in advance and are not easily deferred. This means the market is operating with less slack than it appears. Inventories function as buffers, but buffers are finite. When supply cannot scale and demand is structurally anchored, the system relies increasingly on stockpiles and paper abstraction to maintain the appearance of balance. That abstraction works until it doesn't. The phrase, "the market isn't pricing it in," does not imply ignorance, it implies assumption. The assumption that supply will respond if needed. The assumption that inventories are sufficient. The assumption that substitution or efficiency gains will resolve pressure without consequence. These assumptions persist because they have not yet been forced to fail. Importantly, none of this requires panic or crisis to matter. Markets routinely misprice slow-moving constraints because they do not fit trading horizons. Silver supply is one of those constraints. It does not shock the system, it narrows it. If you follow markets for structure rather than short-term moves, this is where paying attention becomes useful. Consider subscribing if this kind of analysis focused on limits rather than headlines is how you prefer to understand risk. The key insight is simple. Silver supply is not capped by policy or price. It is capped by reality. That cap has not been breached in years, not because demand was weak, but because the system learned to operate within constraint. To understand why that constraint is becoming harder to ignore now, we need to look at how demand interacts with a supply base that cannot stretch, and why this interaction tends to surface only after long periods of complacency. The reason silver's supply ceiling remains underappreciated is not a lack of data. It is a mismatch between how markets think about supply and how silver is actually produced. Investors tend to focus on annual output numbers and assume those figures can adjust over time. In reality, silver's production profile is constrained by decisions that sit far upstream from price. Because most silver is mined as a byproduct, its supply responds to the economics of other metals, not to silver itself. A copper mine does not increase throughput because silver prices rise. A lead or zinc operation does not expand simply to capture more silver revenue. Silver is incidental to those decisions, not central to them. This makes its supply uniquely insensitive to market signals. Primary silver mines do exist, but they represent a minority of global output. Even among those, expansion is neither quick nor guaranteed. Declining ore grades mean more material must be processed to produce the same amount of metal. Environmental regulation and community permitting slow development further. Capital allocation remains cautious after years in which higher prices did not translate into consistent shareholder returns. These are not temporary obstacles. They define the operating environment. This is why the idea of a supply response over time is misleading. Time does not solve constraints when the underlying drivers are disconnected from the asset's price. Even sustained higher prices cannot force silver supply to scale meaningfully if base metal demand remains stable and new projects remain limited. At the same time, existing production is being absorbed by uses that are increasingly non-negotiable. Silver is not consumed for discretionary reasons. It is embedded in infrastructure that governments and corporations are actively prioritizing. Once committed, that metal does not return to the market quickly, if at all. Markets tend to treat inventories as proof of flexibility. But inventories are not production. They are deferred consumption. Drawing them down does not solve the supply problem. It delays its visibility. Over time, reliance on inventories reduces resilience rather than increases it. This is how a hard limit forms without appearing dramatic. Output plateaus. Demand persists. Inventories quietly compensate. Paper markets abstract the imbalance. Price remains contained enough to reinforce the belief that nothing fundamental has changed. The consequence is complacency. The market learns to operate within constraint and mistakes that adaptation for abundance. Risk models incorporate the recent past and assume continuity. The absence of disruption becomes evidence that disruption is unlikely, but constraints do not disappear when they are managed. They accumulate significance as conditions change. When demand accelerates or when confidence in abstraction weakens, the lack of elasticity becomes relevant all at once. Silver's supply ceiling is therefore not a future event waiting to occur. It is a condition that has been normalized. The question is not whether supply can break higher. It is whether the system can continue to function smoothly as pressure builds against a boundary that does not move. To understand how and when that pressure begins to express itself, we need to examine how markets behave when they are forced to reprice limits they have long taken for granted. As pressure builds against a fixed supply base, markets do what they always do first: they abstract. When reality becomes inconvenient, financial systems respond by increasing the distance between the asset and its physical constraints. In silver, this takes the form of paper expansion. Futures volume grows. Unallocated accounts proliferate. Exposure becomes easier to create than metal is to source. This abstraction is not deceptive by design. It is functional. Paper markets exist to provide liquidity, hedging, and price discovery. They allow participants to express views without forcing immediate physical settlement. Under normal conditions, this works efficiently. The problem emerges when abstraction begins to substitute for capacity rather than reflect it. As silver supply remains capped and demand remains anchored, paper exposure absorbs the imbalance. Price signals are softened. Volatility is managed through margin and leverage rather than availability. To the casual observer, the market appears balanced. But balance achieved through abstraction is not the same as balance achieved through supply. Over time, this reliance on paper creates fragility. Each additional layer of abstraction assumes that physical settlement will remain marginal. It assumes that most participants will be satisfied with cash settlement, rollovers, or offsets. That assumption holds only as long as confidence remains high and incentives are aligned. The challenge is that abstraction does not remove the underlying constraint. It delays its recognition. When supply cannot expand and demand does not retreat, the system becomes increasingly dependent on trust in financial mechanisms. The metal itself becomes less visible but more important. This is why silver's supply ceiling can coexist with relatively subdued prices for extended periods. The market adapts by shifting stress into instruments rather than addressing it through production. But adaptation has limits. It relies on behavior remaining stable. When behavior changes, even modestly, the abstraction is tested. A small increase in preference for physical settlement. A slight reduction in willingness to lease metal. A cautious approach to inventory release. None of these actions are dramatic. Together, they reduce the margin of error. At that point, the supply ceiling becomes less theoretical. It begins to influence terms rather than headlines. Lease rates adjust. Delivery windows stretch. Premiums appear in places that were once frictionless. These are not signs of failure. They are signs that the system is negotiating with reality. What makes this phase difficult to interpret is that price may still lag. Abstraction can suppress visible signals even as structural pressure increases. This leads to a familiar misreading, that because price is contained, constraint is irrelevant. In truth, price is often the last variable to adjust. Silver's market structure allows this divergence to persist longer than in many other commodities. Its dual role as an industrial input and a monetary asset encourage financialization. Its relatively small size makes abstraction easier, but those same features amplify adjustment when limits are finally acknowledged. The key insight is that supply ceilings do not need to be breached to matter. They shape behavior long before they are challenged directly. Markets learn to operate within them, but that operation becomes more sensitive over time. Understanding this helps explain why silver can remain overlooked even as conditions tighten. The system appears functional until it is required to do something different. When that moment arrives, the lack of elasticity is no longer an academic observation. It becomes operational. To see how this abstraction eventually gives way to repricing, we need to examine what happens when confidence in financial flexibility begins to waver, and why that shift tends to occur abruptly rather than gradually. When confidence in financial flexibility begins to waver, the silver market does not respond with drama. It responds with selectivity. This is the phase where abstraction still functions but no longer unquestioned. Participants begin to distinguish between exposure and control, between liquidity that is assumed and liquidity that is reliable. That distinction reshapes behavior long before it reshapes price. Confidence does not break evenly, it narrows. Market participants do not suddenly reject paper mechanisms. They simply become more cautious about relying on them exclusively. Hedging horizons shorten, counterparty scrutiny increases. Optionality becomes more valuable than efficiency. These are subtle shifts, but in a market operating near a supply ceiling, they matter disproportionately. As this occurs, the burden placed on abstraction increases. Paper markets are asked not only to provide liquidity, but to mask constraint. That works only if participants continue to accept settlement flexibility without hesitation. When even a small fraction begins to reconsider that preference, the system tightens. This tightening rarely shows up first in price. It shows up in behavior. Inventory holders become more deliberate about release. Leasing becomes less attractive relative to holding metal outright. Physical metal moves less freely, not because it is scarce in absolute terms, but because it is valued differently under uncertainty. At the same time, industrial users adjust defensively. Their concern is not speculation, but continuity. When supply chains feel less elastic, securing access takes precedence over optimizing cost. Buffer inventories are increased modestly. Long-term arrangements are favored over spot procurement. These decisions are incremental, but they reduce the volume of metal available to respond to marginal demand. This is where the supply ceiling becomes operational rather than theoretical. The market can still clear, trades still occur. Prices may even remain stable, but the cost of maintaining balance rises. More effort is required. More conditions are attached. Less slack exists. Financial participants feel this through friction rather than failure. Positions that were once easy to maintain require more capital. Strategies that relied on stable availability require adjustment. Liquidity is still present, but it is less forgiving. That change is often misinterpreted as temporary when in fact it reflects a structural shift. Importantly, this phase does not require a catalyst. It unfolds as the cumulative effect of small decisions made under uncertainty. Each decision is rational. Together they reprice confidence. Silver's supply ceiling intensifies this process because there is no release valve. Higher prices do not summon new supply quickly enough to restore comfort. Abstraction can delay recognition, but it cannot create metal. The system is forced to negotiate with limits rather than bypass them. This negotiation changes how silver behaves relative to other assets. It becomes more sensitive to shifts in preference. Small changes in demand or behavior produce larger effects than expected. Volatility becomes less about emotion and more about structure. If you track markets for these early behavioral signals rather than headlines, this is where subscribing adds value. These shifts rarely announce themselves clearly, but they shape outcomes long before narratives adjust. The key insight is that confidence does not need to collapse for limits to matter. It only needs to become conditional. When that happens in a market with a hard supply ceiling, adaptation becomes more expensive over time. To understand how this process ultimately resolves and what it implies for silver's role going forward, we need to examine what happens after markets internalize constraint rather than attempt to abstract it away. The final stage of a constrained market is not recognition, it is normalization. Once participants internalize that supply cannot respond the way they once assumed, behavior adjusts permanently. The market does not wait for confirmation through a dramatic event. It incorporates the limit into its functioning. In silver, this normalization changes the relationship between price, demand, and availability. Price no longer serves solely as a signal of sentiment or expectation. It becomes a mechanism for allocating a fixed resource among competing uses. That shift is subtle but profound. Markets built on elasticity behave very differently once elasticity is removed. What this means in practice is that silver's supply ceiling stops being a topic of debate and becomes a constraint that participants work around. Industrial users plan with tighter tolerances. Financial participants size exposure with greater respect for physical limits. Inventory holders treat metal less as a trading asset and more as strategic stock. None of these changes require coordination. They emerge naturally once assumptions change. This is why markets often appear calm after a period of adjustment. The absence of visible stress is mistaken for resolution. In reality, the system has adapted to operate with less slack. That adaptation reduces the likelihood of immediate disruption, but increases sensitivity over time. Small shocks carry more weight. Margins for error shrink. Silver's supply ceiling also alters how monetary stress is transmitted. When confidence tightens, monetary demand for silver does not enter an open, flexible market. It enters one already constrained by industrial use and defensive behavior. That interaction does not result in smooth repricing. It results in compression. This is where silver's moves can feel sudden even when they are long anticipated. The market is not surprised by demand. It is surprised by how little capacity exists to absorb it. The speed of adjustment reflects years of deferred recognition. Importantly, this does not require silver to become scarce in absolute terms. It requires only that availability be conditional. When access depends on timing, counterparty trust, or willingness to release metal, price becomes more sensitive to behavior than to forecasts. This is the core reason the market has not priced the supply ceiling fully. Constraints that operate through behavior are harder to model than constraints that operate through data. They do not fit neatly into spreadsheets. They reveal themselves through friction. Understanding this reframes how silver should be interpreted. It is not a bet on shortage. It is a signal of how modern systems handle limits. Silver shows what happens when abstraction meets reality and reality does not move. For observers, the value lies not in predicting a moment of rupture, but in recognizing how adaptation reshapes the system. Markets rarely fail where limits are known. They struggle where limits are ignored or assumed away. If this framework has clarified why silver supply has effectively hit a hard limit and why the market has been slow to reflect it, consider sharing this perspective with others who analyze markets structurally rather than emotionally. And if you've seen similar dynamics in other commodities or systems, add your insight in the comments. These parallels often matter more than isolated examples. Silver's supply ceiling is not a warning. It is a condition. The question is not when it breaks, but how markets behave now that it cannot bend.